Ever wonder why most retail traders end up losing while institutions just keep on stacking wins even in brutal markets? Well, the gap is actually a lot bigger than you think. So today I'm going to show you exactly how the institutions make money under any kind of market conditions and what you can do to finally stop getting absolutely wiped out. So the gap isn't just about money or tools or experience. It's actually more about structure, and it's also about the way that you see the market and the way that the market actually sees you. And once you understand how institutions not only survive but thrive during every market storm, how they stay alive through absolute chaos while everyone else is getting wrecked, you'll start to realize something really uncomfortable. Most people aren't losing because they're bad traders. They're losing because they're using a playbook that was never built for them. They lose because they never realized what game they were actually playing. They think that they're making these smart decisions. They think that they're analyzing patterns. They think that they're outsmarting the market. But in reality, they're sitting at a roulette table where the house controls the wheel. Let me explain. In roulette, you can bet red or black, and it feels like a 50-50 shot. But the house has zeros built into the wheel, not to make the game more fun, but to ensure that over time, the house always wins. The player can get lucky, sure, but the structure guarantees the casino wins the game overall. Now let's replace red and black with longs and shorts, 0 and 00 with liquidity hunts, the house edge with market makers engineering price to sweep both sides. Suddenly, the illusion just completely disappears. Markets don't just move randomly, they move strategically, and they move strategically toward liquidity. Your stop loss isn't bad luck, it's the house taking your chips before spinning the wheel again. And here's the part that most traders never actually understand. The house doesn't care who wins each spin, it cares ultimately only who wins from the structure, and the structure is built to sweep liquidity on both sides, long and short, before it actually goes and makes the real move. So just like the roulette table, the outcome is designed to favor the one running the game, not the ones that are playing it. Retail, they're the players, and institutions, they're the house. Now, here's where it gets interesting. Before every major move, you'll notice the same pattern. First, we sweep the lows, taking that long liquidity, and then we go and sweep the highs, taking all that short liquidity. And then the market is going to be balanced by the market makers, bringing it to its true, real direction. Now, this is not random. This is not noise. This is the casino collecting both sides before the wheel then spins for real. Retail traders lose not because they're wrong, but because their entries and stop losses sit exactly where the house expects them to be. Imagine walking into a casino and betting red every time because the chart looks bullish. The house smiles because they don't need to beat you, the structure will. You are not losing trades, you are paying the house edge. This is why trading can feel rigged, because structurally, it actually is. So let's take a look deeper now into the retail problem. If you study how most people are taught to trade, you'll notice something immediately, that everything is rigid, everything is binary, and everything rests on one fragile idea. If this exact line breaks, I'm wrong. And that's an invalidation. And the market just loves that mindset. Retail traders will go and place their stop losses at the same obvious levels, the local high or low, and treat those lines like some kind of divine truth. Yet these levels are the first targets that liquidity hunts down. One wick, one liquidity sweep, one engineered move, and you're absolutely gone. Not because your overall thesis was wrong, and most likely it's right on a higher time frame, but because your system had no structural integrity. And the tragedy is that this approach works the same at any tiny size. A $500 account can survive almost anything. I always keep making this point, but as soon as we try to scale, the entire system snaps. And that's because when you're trading small accounts, you can simply add more collateral. You can simply only lose a small bit. It's not as emotional, but we want to learn, especially with a trading system like ours, is how to handle 6 or 7 figures or more. So these small traders, they just constantly start over again and again, thinking each time that the problem is them. They go and find some more money, but the reality is it's that the framework that they were given. And the institutions have a different solution. The institutions, they don't look at the market like this. They don't obsess over a single invalidation line. They don't hand their entire future to one single candle. And they certainly don't treat risk as a gut feeling. They operate from 3 principles that are universal across every serious trading desk. First one is that invalidation is dynamic. The second one is that risk is probabilistic. And the third is that time is a tool, not a threat. These principles don't just help you to survive, they actually help you to scale from 10K to 100K to $1 million to $100 million or more. And the system, it doesn't break. So let's take a look at them one at a time now. The first one is dynamic invalidation. and it's a range, not a tripwire. So retail traders, they draw these lines, but institutions, they map zones. And our system is actually built the same way. Instead of treating stop losses like explosives waiting to go off, the system simply adapts as the market breathes. And for us, trading Bitcoin futures, it defends down to the power law support, the deepest structural boundary in Bitcoin's behavior. And it scales only when challenged, not because a random line was tagged. And it uses these liquidity sweeps as a signal and not as a reason to panic. And it trades inside a very broad statistical band instead of hyper-focusing on short-term noise. And we got these bands from the PhD physicist Giovanni Santastasi, who actually discovered the power law model that Bitcoin follows for the very first time. Now, I've said this over and over again to new clients, and that is that they don't get hunted anymore when they stop thinking like prey, because dynamic invalidation is exactly how you stop being prey. Number 2 is that risk is probabilistic, not emotional. Now, when Bitcoin drops 30%, most traders panic, but institutions don't. Because institutions, they're not looking at candles, they're looking at distributions. And the Bitcoin power law model shows us exactly where this asset has historically bottomed across its whole time of price action, almost 16 years. And it breaks price into these kind of quantiles, zones where risk is cheap, fair, or expensive. And when you understand this, everything shifts and you start to see that risk is actually expensive at the top of the market and risk becomes very, very cheap when we're down near the lower bands. And that bottom 1% is where the long-term opportunity consolidates. Now, this isn't a prediction model. It's actually a probability map, and retail feels this kind of risk, but what institutions do is they price the risk, and our system uses the same logic by positioning lightly when prices are really high and accumulating only when the long-term math is actually on your side. Now, let's jump into the third one, time, and this is the variable that quietly destroys retail traders. People think that the market beats them because of volatility or manipulation, but the truth is actually far simpler. The market beats them because it moves when they're not there. Bitcoin runs 24/7, and of course, it's always trending upwards. So most of the time, if you just held on for long enough, you would eventually be taking profits at an all-time high. But what happens is liquidity flips when people sleep, they get stopped out, sentiment shifts when they're at dinner, a perfect entry might appear at 3:40 a.m. and disappear by 3:17 a.m. Now, institutions, they don't miss these moments, and retail traders, they actually miss all of them, not because they're unskilled, but because they're actually human. So time is the variable that no one teaches you how to manage, yet it's the very thing that an entire strategy can rest on. And this is where automation stops being optional, because a market that trades 24/7 must be fully automated, and it becomes the only way to actually compete with others that are using automation. So people hear automated trading and they kind of think of it as some kind of convenience or passive income. But automation, it's not about ease, it's actually about continuity. It's the bridge between your intention and institutional execution. Now, our system, it doesn't replace any kind of logic. It actually preserves it consistently, flawlessly, and without any kind of human emotional distortion. So if you tried to execute our system manually, you'd have to wake up multiple times every single night. You'd have to watch every single retracement. You'd have to monitor volatility across time frames. You would have to calculate sizes on the fly. You'd never be able to hesitate. You'd never be able to skip a day. You'd never get tired, and it would absolutely break you. Now, algorithms, they don't break because they don't feel fear. They don't feel greed. They don't get discarded. They simply follow the rules that you set out during the blueprint, and they execute with this perfect discipline. And that's also the difference between an algorithm and a bot. You actually need both of them. Some people think that just a kind of grid bot is going to do the job, but that's just mechanical execution. An algorithm is the brain that the bot needs to provide the execution with. So we want to have both. We want to have an algorithmic solution executed by a smart bot. And this is exactly what institutions do to automate absolutely everything, and why retail traders who don't, they're always fighting a losing battle. Now let's take a look at how all these three advantages become one under the Minotaur trading system. Minotaur isn't getting hunted because it's not trading where retail trades. It's trading where the house trades, where the institutions are moving. It moves with the liquidity, not into it. And what we're doing is we're not trying to predict price, we're actually reacting to it. And we're treating Bitcoin and other assets the way institutions do, as a probabilistic, constantly evolving system. And once you trade with institutional structure, something absolutely incredible happens. You start being the one that the wheel can't beat. And when you combine dynamic invalidation, probabilistic risk, and a time-aware automation, you get something most retail traders have never seen. A system that behaves like an institutional desk. It runs automatically 24/7, but it can do it in your own pocket. And that's the beauty of where we are in trading in 2025, 2026, and beyond. We have access to these tools as retail traders. We can act like an institution if we have the right tools. Because what we're doing is we're using the structure that institutions have used for decades. So if any of this resonated, if you finally see the gap between how most people trade and how institutions approach the market, then your next step is really simple. Go to the links below and book a call with my team. We're offering full free consultation calls. We're going to show you how the system works live, answer any questions you have, and help you understand how the Minotaur trading system can fit your goals. So go ahead and click on one of the links and let's get you set up on the Minotaur trading system.